Hi guys, it's Russell, and I thought I'd do a quick video tonight about short selling. So a few of you have been messaging me on Facebook and in the Discord asking about how the hell do we short a stock. So shorting a stock is not a difficult thing. I just wanted to go through the basics of it. It's really not complicated, but it can be intimidating to a new trader. I remember being intimidated by it when I started over 8 years ago. So the first thing I want to mention about short selling is that you do need a margin account. It's because you're borrowing stock from your broker. And it's highly risky because you can lose more than you invest, although that's in theory, and I'll go through that a little bit about how that's just not really a big issue. But that's what people will tell you, is that shorting a stock is extremely risky, and it's not. Anyway, I'll just quickly go over the basic concept because it seems to confuse a few people, and it is a little bit weird when you're first starting out. So, step one for shorting a stock. So basically what you're doing when you short a stock is you're looking to make money when the price of the stock falls. So that's in stark contrast to when you're buying a stock and hoping the price goes up. And some people object to this from an ethical point of view, saying, well, why? I don't want to bet against a company price going down. It just, I don't want to make money from a company stock. But in reality, short sellers actually provide a lot of value in the stock market. They provide liquidity. And in the short term, like in a day trade or even a few weeks, you're really not hurting the company, especially if you're a very small trader like us. So there's definitely some objections to short selling, but really it's not something that I disagree with, and I think it's a great tool to add to your arsenal in the market. So you're betting that the stock falls in price, and basically what you do, this is 5 simple steps. So the first step is you borrow the stock from your broker. So your broker has a whole bunch of stocks, and you can basically just say, hey, I want these stocks. Will you lend them to me? For free, essentially, but not quite free, because they do charge a small interest fee. Now, this is negligible if you're doing an intraday trade, but it can add up if you're holding it for a year. And your different brokers will give you the different interest rates that they charge you for borrowing the stock from them. But apart from this interest fee, there's no charge associated with a broker saying, hey, here's 100 shares of XYZ stock. Go ahead and sell these on the market at the market rate. So for this example, I just want to say, okay, imagine you borrow one stock from your broker for $1 per share. And you have that free, now you own that, and you can basically then sell that stock on the market to anybody that you want for $1 a share, because that's the going rate. Well, then imagine that you're right and the stock price falls, and it falls a big amount, 50% in this case. And now that stock is worth only 50 cents a share. Well, you sold it to somebody for 1, and you can now buy that back for 50 cents. So you got $1 from them, and then you spend half of $1, so you're left with a 50% or 50 cent profit in this case. And then all you do is you give the stock back to your broker and pay this tiny interest fee if you held it for a long period of time. So pretty simple, right? Borrow the stock, sell the stock to somebody, buy it back if the price goes down, and you keep the difference. So basically it's not a difficult concept when you sort of lay it out simply like this. But there's a few extra things that you might want to consider. So let me go over to my brokerage account and give you an example of one of the stocks that I shorted recently, this guy. So I'll walk you through this and then I'll explain how to place one of these short sells. So this stock had taken this huge move up, from 0.7 to almost $1, so 0.86. And usually when stocks move like this, they'll often have a fade, so this one faded down in price. So what I did is on this first candle, I basically said, okay, this move is way over cooked, I'm going to start a short sale. So I borrowed shares from my broker around this level, which was probably a little bit early because, this could have kept going up and I'd been what they call squeezed, where I'm forced to cover my shares at a higher price and lose money. But in this case, I got lucky and the stock price continued down. And then what I did down here is on this first green candle, I bought my shares back. So I pocketed the difference from 0.85 to 0.77 roughly. And that's about an 8% or 10% profit. So the idea here though is I waited for the first green candle to form before I said, okay, this could reverse and continue back up. And sure enough, it did do that later on in the day. And over the next few days, it continued up to, up to about this level, 0.91. I think it went up again, yeah. So it kept going up over the next few days. I think it hit $1 or close to $1. So essentially, I use short selling for intraday trades only. But basically that's how I do it. It's really simple. You can use things like moving averages as long as it's trading below the moving average, in this case the 5 MA, and say, okay, if it starts to break above that, then I'm covering or buying back the shares. So people are, I mentioned this idea that people are saying it's very, very risky because you can lose more money than you put in. And in theory, that's true. Imagine you went short here and the thing went all the way up to here and then kept going. You could lose twice your money if you bought at 0.7, say, short. So you shorted at 0.7 and this thing doubled. You'd lose all your money plus it all again. But in reality, you set stop losses the same way as you do with a long trade. So, for example, if I'd gone short here again, thinking that it was going to break down further, which it could have done, but in this case it didn't. As soon as it started to go on this uptrend, maybe if it comes up to about here and then starts to break these highs, then you'd cover and buy back your shares so that you didn't take an infinite loss. Because that's the big thing. If you're going long, you can only lose the maximum amount of your investment, $100, say, if you put $100 in. Because the worst that can happen is it goes to zero. But a stock price can, in theory, go to infinity. So you have to be really careful with that. But honestly, if you let a stock go up to infinity, you're doing something wrong, right? You should set a 5% or 10% stop loss and everything. So that's why when people say that short selling is really risky, it doesn't have to be. You're in control. You set your own stop losses. So basically, this is really cool because you can take advantage of different price action. So for example, if you saw the news coming out for this spike, you could buy some of the stock here, let it run up and sell it up here for a long trade. So you do the scalp. And then as it starts to fade, you then go short and you can make some of your money back, maybe even the same amount again, right? Then we watch it and you watch the price action for it to base, and as soon as it starts to look bullish again, you can buy back in long and continue this cycle. And one of the guys in the Discord, Sean, does this really well on Apple every single day. I do it as well. Let me just give you an example of Apple. Let's do 30-minute time frame and zoom out. Actually, 30 minutes is way too crazy. Let's do 5 minutes. So any stock that trends in a channel of any sort is awesome for this kind of shorting and doing long trades on. So for example, in the morning here, you can go long, and then as soon as these red candles form, you can go short, and then you can go long again, and as soon as these red candles form, you go short, and you can basically do that all day. I've done it, and Sean in the Discord group does it, and it's a great way to basically make money on the way up and on the way down. So that's the basic essentials of short selling, and I hope that's clear. It's not the easiest concept to get across. And then people were asking about how to actually place these trades. So let me show you on Webull how that works. So on Webull, basically all you do is you come to here and you hit short, and you put in your limit order as you would. But instead of hitting the ask like you would do for a long, this is the price people want for the stock, you put in a limit for the bid. So people are basically wanting to buy the stock here, and that's what you're doing. You're selling them the stock when you go short on something. So here you would put in a bid for this, roughly, somewhere in this range. Sorry, a short. And then that's it. You basically execute the order as you normally would, and it'll come up on your order form as it normally would, except it'll say negative 7,000 shares or whatever you want. And then when it comes to wanting to close the trade, hopefully for a profit when the stock falls, the stock price falls, all you do is you buy back your shares as you would if you were going long. And that's it. You go short, set your limit, then buy back the shares once you're done. Remember, that's what you do. You sell the stock to somebody. When the stock drops or goes up, hopefully drops, you then buy the stock back and you give it back to your broker. Now that's all automated, so you don't have to actually give it back, and it just happens on the broker platform. So it's pretty straightforward. Now, on some brokers, and on Webull until recently, there is no short button. There's just buy and sell. So in that case, all you do for a short is you hit sell first. So you can do that, it goes through just fine. And you can hit sell the number of shares you want, and boom, you're short stock. And then when you want to cover or buy them back, you just buy. So it's like the same as you would normally, but in reverse. So pretty easy. Sometimes there isn't any stocks to short. That can happen if it's a stock that is falling extremely quickly. The broker has lended out all the shares they can, and there's no more shorts available from your particular broker, which gets really annoying, because when a stock is falling really quickly and heavily, that's when you want to short it the most, right? But unfortunately, everybody has the same idea, so the broker has lended out all the shares. So I hope this has been helpful. I think the mechanism of short selling isn't too difficult, but it's a weird concept to get your head around. I still have some problems because I don't short very often. And sometimes I'll get excited when I see, I'm short a position, and I'll glance back at it and I'll see the price has gone up, and I'm like, I get that dopamine rush of thinking I'm making money when actually I'm losing money because I'm short on the position. So it takes a bit of getting used to. But in this market, it's a really powerful tool to have, and if the market continues to not behave exactly as we want, then people are going to be shorting more. So it's a useful tool to add. So if you have any questions, let me know, and I hope you enjoy your weekend, and I hope this was helpful. Alright guys, thanks again.